Hi, you're watching Investor Insights, and this morning I just want to share some news insights with you. Now, last night the Dow fell the Dow, the S&P, Nasdaq all shed about 1 percentage point and a half. Supposedly it's blood all over the street, and in theory it's because of some again Fed tapering fears. The first thing that I want to say, Fed won't taper, and even if it does, it's going to be of insignificance, and if it was, it's going to be retracted anyway. Apparently, according to the consensus estimates, all these commentators and economists from Bloomberg think that the Fed's going to taper by roughly about 10 billion a month. Wow. So they're purchasing 85 billion and they might scale back by 10 billion. Man, you're hooked on heroin. You need 8 shots of heroin a day. I'm gonna fix up the problem by only giving you 7. This doesn't solve anything. This is not tapering. You're still overloading the whole place with free money. This is crazy. This is just absolutely crazy. But anyway, I'd like to share with you 4 separate articles, and the first 2, I think I want you to guess who's the economist and who the fund manager is. So in the first article, you've got one guy who says the S&P could trade between 1850 to 1900 relatively easy. Although market multiples are edging down, that means the markets have fallen just a little bit. Investors should expect the S&P 500 to go as high as 1900 over the next 15 months, this bloke reckons. You can look at so many different valuation metrics, this guy said. If you look at PE ratios between 16.5 to 16.7, it can get to 1850 to 1900 relatively easily with a more conservative valuation than what consensus estimates are projecting. His projection was for the end of year 2014. Now, the S&P is trading at 1660 this morning, and this guy expects it to climb about 240 points, which is what, about 15%. Now, this market is overstretched. And what I've been telling you is that when you're living within a bubble, you can't really see outside. And your mentality is distorted, your expectations are warped, and your valuations are just fanciful. But what happens is the bubble mentality means everybody expects blue sky potential. So you've reached an all-time high, and they're just going to slap another 15% on top of that, and yet the economy, the real economy, is contracting. Now, the second article, this guy reckons that the market valuation looks like 2007 all over again. This guy bases his long-term valuation model on some median appreciation potential, which he has said has shown statistically to have predictive value of where the market is headed. Right now, that number is relatively low. It's down in the range that it was in 2007. That tells me that over the next few years, the returns on stocks aren't going to be particularly good, and they could even be negative. So, can you guess who the hedge fund manager is and who the economist is? Well, obviously, the first guy is the hedge fund manager, because he has to say that markets are going higher for people to put money into his company or whatever company there is out there to help prop up these markets. I mean, this is a huge case of a whole bunch of lemmings being the biggest fools. And the second article, The Economist, well, for some reason, he hasn't worked this out the past 3 years, but he's only worked it out now, that the market looks stretched. And he says that stock prices look eerily like 2007. Well, I'm sorry. They will look eerily like 2007 when the share prices are the same as 2007. The stock market is 12% higher than it was in 2007. And the hedge fund gurus are saying that they expect another 15%. Go figure. This guy has had a lifetime of education. He's a professor somewhere. And I don't know how long it's taken him to work this one out, that the markets are stretched. So just because a person looks educated and has a beard, it doesn't mean that this guy has a sense of reality or he's got any even common sense whatsoever. But I think the last two articles are more important, because the last two articles have a lot of rhetoric about what the Fed's intentions are. Now, the Fed's composed of many presidents from different areas, and they each vote. But at the end, Bernanke's got the veto, just like the president has. So it doesn't matter what these guys say, whatever Bernanke says, that's the way the Fed's going to go. All right, let's just face facts. Whoever reckons that there's a real vote, it doesn't really matter. But more to the point, this guy, Jeff Bullard, reckons that, and this was just yesterday morning, the United States does not face destructive asset bubbles of the scale of the 1990s, like tech wreck, 1990s technology stock shock, or the more recent housing boom, a top Fed official said on Thursday. I don't see a bubble of that magnitude right now for the US economy, St. Louis Fed President James Bullard said in response to an audience question after remarks at a breakfast. Now, this guy reckons that there's no bubble. Right? A blind bat, well, bats are blind, right? A blind idiot can see that there's a bubble. So if you've got a voting Fed member, you can't see it. How the hell do you expect the rest of the world to work it out? To just believe anything that they say. Because if a voting member reckons that there's no asset bubbles, there's a green light for people to just jump in and speculate some more. And this one is from the same person, but very similarly, it's got some very ominous rhetoric behind it. And I think this article is the more important one because it sort of gives you an idea as to what I've been saying was going to happen. Now, this guy's been saying that, and I'm quoting him, inflation has been running very low. I've been concerned about low inflation. James Bullard, president of the St. Louis, told club luncheon somewhere, who cares. There has not been much indication so far that it has been ticking back up towards target. Their target being 2%. The Fed's policy setting committee has set a target. They've set it at 2%, Bullard said. Once you've set it, you had better have some credibility that you're going to hit it. And then it just goes on about some crap about tapering. But here's the situation. I've made videos on this one recently about the Fed tapering and how it's just a lot of bullcrap. You've got members of the Fed who are now coming out and saying that inflation is too low. Inflation's too low. It's not even running at half of what they want it to be, at 2% annualized. Mate, inflation's running at 5 to 10%. And through some fairyland methodology of working out CPI, they somehow come up with 0.7%. So inflation's now too low, and he's worried about it. That is exactly what I've been saying all along, in that not only are they not going to taper, but they're using this fairyland CPI numbers, or inflation numbers, to prepare the market for what they're going to do next, which is actually more QE. This is very important that you learn to read between the lines, because the rhetoric that's given by especially voting members of the Fed, they actually, the best way to describe it is, these guys aren't so clever. These guys think that by sneaking in the odd comment here or there, or they could be slipping up, they're allowing themselves a bit of cushioning for when they actually come out and say, right, we need more stimulus. Let's print some more money, let's have some more QE. Because ultimately, their goal is to have inflation that's so high that their debt is wiped out. They've got $17 trillion in debt, and there's no way that they can pay it back. It will never happen. The fact that the debt market hasn't collapsed yet is because of all these bond purchases keeping rates low. Because if the market was to decide the rates, interest rates would just skyrocket. And the US government, or the Fed, will be broke because it cannot afford to pay the interest on $17 trillion. As I've said before, the interest bill on $17 trillion is $250 billion at 0% interest. If interest were to go back to just a below norm of 5%, the interest bill would be $850 billion. Easily. How are they going to finance that? They already have a budget deficit of over $1 trillion. What? They're going to double their budget deficit to pay back their creditors? If you believe that, then you're just a fool. And there's nothing more I can say. The only way to get rid of this debt is to make it meaningless. And they're going to do exactly what's happened to Zimbabwe, or hopefully not on such a big scale. But if they can find a way to let inflation run and look at you straight, and keeping a straight face saying that inflation is not rampant, that's going to destroy the debt, or the debt's value, I should say. Because if inflation runs, I can't give you a number, but let's just say inflation runs wild and it now costs you $300,000 to buy a loaf of bread, their debt will be meaningless. And the Chinese and the Japanese and whichever sucker's holding this debt is going to be left scratching their head going, well, yeah, they're going to pay us back. And they will pay them back, but they're going to pay them back in a meaningless currency. And this, ultimately, is going to lead to the demise of the US dollar. A currency crisis and a treasury crisis is the same thing, because a treasury is just an IOU of US dollars. So if the IOU has no value, then the currency has no value. Well, you've heard it first. You can make up your own mind. I'm not trying to create any propaganda and badmouth them, but it's clearly obvious what they're doing. And It's up to you to now work out if you believe that the market is overstretched, whether it be real estate, the stock market, or the bond market. And the only advice that I can give you is, if you're going to speculate, and there's absolutely no investment theory behind this, if you put money into any of those into any market right now, I'm telling you, you're not investing. You're just speculating. You're not even trading. You're chasing fanciful expectations. You're chasing warped returns. It's all fantasy land. And ultimately, at the end, you're holding these bonds, this real estate, or these stocks. You're gonna get crushed.